It feels calm on the surface, but beneath the headlines, the silver market has already crossed into hostile territory. While most people are just starting their day believing prices move smoothly and logically, something far more dangerous is unfolding in real time. This is not a normal rally. This is not excitement or speculation. What we are witnessing right now is a structural break, a moment when paper prices and real metal stop speaking the same language. And when that happens, the people who think they are winning often discover too late that they are standing on a trap door. Here is the uncomfortable truth most investors are not prepared to hear. A rising silver price does not automatically mean rising wealth. In fact, for a large portion of American investors, especially those who have patiently stacked physical silver for years, higher prices can trigger a financial ambush. The market celebrates record highs, but the tax system quietly sharpens its knives. Gains that look life-changing on paper can be cut nearly in half the moment you try to turn metal into money. This is where psychology becomes more dangerous than volatility. When people see silver surge, their first instinct is relief, validation, a sense that patience has finally paid off. But markets do not reward emotions, they exploit them. The moment you act on that relief, the rules change. Your silver is no longer treated like an investment. It is treated like a collectible grouped with items the system never intended to protect wealth. That single classification alters everything that follows. At the same time, something unprecedented is happening behind the scenes. Physical silver is becoming harder to move, harder to source, and harder to price honestly. Supply chains hesitate, ships wait, dealers adjust quietly. Yet the official price keeps printing numbers that look clean, precise, and authoritative. This disconnect is not accidental. It is the fault line where future pressure builds. This chapter matters because it sets the frame for everything that follows. This is not a story about chasing price. It is about understanding structure, incentives, and timing. Those who grasp that difference early protect their gains. Those who don't discover that being right about silver was never the hard part. If you're following this so far, type 1 in the comments. Now let's pull back the curtain on the first illusion that traps most silver holders, the belief that all gains are treated equally. On the surface, the financial system claims neutrality. A dollar earned is a dollar earned. But beneath that slogan sits a tax code that quietly ranks your choices and punishes the ones that threaten monetary control. Silver, despite being money for thousands of years, sits on the wrong side of that ranking. The moment you decide to sell physical silver, you are no longer an investor in the eyes of the system. You are reclassified. Your asset is labeled a collectible, placed in the same category as rare coins, art, or vintage wine. That single word changes the math completely. While traditional assets like stocks or funds benefit from preferential long-term capital treatment, silver is pushed into a higher bracket by default. Not because it is riskier, not because it is speculative, but because it exists outside the paper ecosystem. The system prefers you to stay inside. This is where the gap between expectation and reality widens. Many people assume they will pay roughly the same rate as their peers who sell equities. That assumption alone can cost tens of thousands in lost purchasing power. The shock does not come from the price of silver. It comes from the realization that the system was never designed to reward holding tangible money. What makes this more dangerous is timing. Silver tends to be accumulated during periods of stress and sold during moments of relief. That relief often coincides with broader financial instability, rising incomes on paper, and higher effective tax exposure. In other words, the very conditions that make you want to sell also maximize what gets taken from you. And while individuals focus on charts and spot prices, institutions focus on rules. They understand that taxation is not just a revenue tool, it is a behavioral lever. It discourages exits that could destabilize confidence and funnels capital back into favored channels. That is not theory, that is design. By the time most investors realize this, the decision window has already narrowed. The sale is triggered, the reporting begins, and the numbers become locked. Understanding this mechanism before acting is not optional anymore. It is the difference between preserving wealth and watching it quietly bleed away. While most investors were distracted by holidays and headline noise, the physical silver market revealed its true nature. For a brief window, the machinery that normally keeps prices aligned simply stopped working. Trading screens still glowed. Numbers still updated, but the flow of real metal slowed to a crawl. This was not a glitch. It was a stress test, and the system did not pass. Physical silver does not move at the speed of algorithms. It moves through ports, refineries, vaults, and shipping lanes that are vulnerable to politics, policy, and hesitation. When uncertainty enters that chain, price discovery fractures. Paper markets can trade endlessly, but physical supply pauses. During that pause, premiums tell the real story, not spot prices. What happened during that blackout exposed a structural weakness most people never notice until it matters. Buyers who needed immediate delivery were suddenly paying far above the official price. Sellers, meanwhile, discovered that liquidity was selective. If you had metal, it was valuable. If you needed to convert it quickly, the terms were no longer in your favor. This is the moment when the idea of the price becomes misleading. There is the number printed on screens, and then there is the price that clears real transactions. When those two separate confidence erodes, dealers become cautious, spreads widen, and the investor who thought they were sitting on a clean profit discovers friction they never modeled. This is not a conspiracy or a rare anomaly. It is the natural result of a market where leverage dwarfs inventory. Paper promises multiply because they are easy to create. Physical metal does not. When pressure builds, the paper side absorbs the shock until it cannot. Then the stress transfers to delivery and premiums explode. For long-term holders, this moment should be clarifying. Scarcity is not theoretical anymore, it is observable. But scarcity alone does not guarantee favorable outcomes. Without understanding how and where liquidity actually exists, value can become trapped at the worst possible time. Once the divide between paper silver and physical metal becomes visible, a harder question follows: why does this imbalance continue to exist? The answer is leverage and the system's deep reliance on promises instead of delivery. Paper silver functions only because most participants never demand the metal itself. As long as contracts settle digitally, the structure appears orderly and controlled. But that order is fragile. The volume of paper claims now exceeds the amount of silver that can realistically be delivered. This is not a temporary distortion. It is a permanent feature of modern price discovery. In calm periods, it suppresses volatility and keeps prices contained. Under pressure, it becomes a fault line. What has changed is the source of demand. Silver is no longer dominated by investors alone. Industrial users have stepped in aggressively, and they do not accept paper settlement. Production lines cannot run on contracts. They require physical silver delivered on time and in bulk. When these buyers bypass futures markets and negotiate directly with vault holders, the paper market loses its authority. That shift explains a puzzling pattern. Large waves of paper selling no longer produce sharp declines. Prices pause, absorb the pressure, and continue higher. The selling is neutralized because real demand exists elsewhere off the exchanges. Traditional models fail because the structure underneath them has changed. At the same time, visible inventories continue to shrink. Metal leaves the system not because it vanished, but because holders refuse to sell at prices that ignore rising risk. Less inventory increases sensitivity. Sensitivity widens spreads and raises premiums. This is how confidence erodes quietly long before the broader public notices. Now we reach the force that converts hidden stress into unavoidable pressure: industrial demand. For decades, silver was treated as plentiful and replaceable. It was consumed quietly and rarely feared as scarce. That assumption no longer holds. Modern technology has turned silver into a strategic input, and the market is struggling to adjust. Silver's unique properties make it difficult to substitute. High conductivity, durability, and performance under extreme electrical loads place it at the core of modern infrastructure. Advanced computing systems, data networks, renewable energy equipment, and electric transportation all depend on silver in forms that are rarely recovered. Unlike gold, which is stored and reused, silver is largely consumed. This distinction matters because industrial buyers behave differently from investors. They do not speculate or time the market, they secure supply. Their demand is steady, contractual, and driven by production schedules rather than price charts. When delivery is uncertain, cost becomes secondary. That is why manufacturers increasingly bypass exchanges and lock in physical metal directly. Meanwhile, supply growth remains constrained. New mining projects are slower, deposits are lower grade, and regulatory hurdles stretch timelines. Production struggles to expand while consumption accelerates. The result is a persistent gap between what the world produces and what it uses. Recycling cannot close that gap at scale. Extracting silver from electronics and industrial waste is expensive and inefficient. In many cases, recovery costs exceed the value of the metal itself. As a result, above-ground inventories continue to decline even as demand grows. At this point, pricing becomes arithmetic, not opinion. When usage exceeds production, stockpiles shrink. When stockpiles shrink, control shifts. The market is entering that phase now, even if official prices have not fully caught up yet. As supply tightens and demand becomes rigid, the silver market enters a phase where policy outweighs speculation. This is where many investors lose perspective. They focus on charts and momentum, while underestimating how quickly rules can override fundamentals. Silver is now crossing into that territory. Trade policy matters because silver moves through borders, refineries, and shipping routes governed by regulation. Tariffs, export controls, and licensing requirements do not gently influence prices. They reset the entire cost structure. A transaction that made sense yesterday can become uneconomical overnight. Even brief uncertainty is enough to disrupt physical flow. Shipments pause, deliveries are delayed, buyers willing to pay premiums gain priority. Physical markets respond immediately while paper markets continue pricing an environment that no longer exists. This delay creates distortion. That distortion shows up as a widening gap between quoted prices and real transaction values. On screens, everything appears stable. In practice, metal becomes harder to source, harder to move, and harder to replace. Once this friction enters the system, it does not disappear quickly. It embeds itself into contracts, inventory strategies, and risk calculations. For investors, this phase is misleading. Rising prices feel reassuring, but they also draw attention. When a commodity shifts from background input to strategic material, governments respond. History shows that taxation reporting requirements and controls tend to follow increased visibility. This is the transition from a market driven by opportunity to one shaped by oversight. Those who recognize it early can position calmly. Those who ignore it are forced to react later, usually under pressure. Silver is no longer just about price appreciation. It is about navigating a system that is quietly tightening around it. This is the point where taxation stops being a footnote and becomes the central risk. Most silver holders assume taxes are a problem for later, something to calculate after a sale. In reality, the outcome is largely determined long before any transaction occurs. The framework is already set, waiting for activation. Physical silver is not treated as productive capital. It is classified in a category that assumes speculation or personal collecting, not long-term financial defense. That single designation changes everything. The moment you sell a different rulebook, applies one that was never designed to reward patience or foresight. It is designed to extract value when visibility is highest. What makes this dangerous is how automatic the process is. There is no negotiation and no discretion. A sale creates documentation. Documentation creates obligation. Once that chain begins, flexibility vanishes. Your intent no longer matters. Your strategy no longer matters. Only compliance does. Many investors fixate on price targets without modeling the after-tax reality. They celebrate the move, believing they have won, only to discover that a large portion of the gain was never truly theirs. The higher the price rises, the more attention it draws, and the more efficiently the system captures its share. This is not about morality or fairness. It is about incentives. Capital is encouraged to remain within approved paper structures. Assets that exist outside that system face friction at the exit point. Silver, by its nature, challenges that design, and the response is predictable. Understanding this before acting changes the entire decision process. The real question shifts from when to sell to how to hold. Those who recognize that distinction early preserve choice. Those who don't discover that the decision has already been made for them. Once taxation is understood as a built-in risk, attention shifts to control. This is where many investors realize they were taught the wrong order. They learn to focus on buying well, then selling well, and only afterward dealing with consequences. In reality, structure comes first. Everything else is secondary. Control in the silver market does not mean forecasting price. It means deciding ahead of time how value will be treated when conditions change. Silver forces this awareness because it exists outside the default financial system. That independence gives it power, but it also removes protection. The system favors assets that are simple to monitor, simple to report, and simple to manage. Paper instruments fit perfectly. Physical assets do not. As soon as physical silver becomes visible through liquidation, resistance appears. Reporting increases. Oversight tightens. Options narrow. This is why experienced participants think in frameworks rather than individual trades. They ask how an asset is categorized, what actions trigger attention, and where flexibility is preserved. They understand that the same ounce of silver can lead to very different outcomes depending on how it is held. Timing alone cannot solve this. Waiting for a higher price does not change classification. Acting faster does not eliminate reporting. Without structural planning, every exit leads to the same bottleneck. Choice disappears at the moment confidence peaks. This chapter demands a shift in perspective. Silver is not just something to trade. It is a strategic holding that must align market reality with legal structure. Ignoring either side creates imbalance. Those who recognize this early retain room to move. Those who wait until after action discover that systems do not adjust backward. They only move forward. Once structure is understood, the final layer comes into focus: strategy. This is where awareness turns into advantage. Most investors never reach this stage because they stop at analysis. They see the problem but fail to redesign their positioning around it. Strategy is the bridge between understanding risk and avoiding it. In markets like silver, strategy is not about maximizing upside. It is about minimizing forced outcomes. The greatest risk is not price volatility, but being pushed into action under conditions you did not choose. That is how value leaks away quietly and legally. Effective strategy starts with recognizing that not all ounces are equal. The same metal can carry very different consequences depending on how it is held, reported, and transferred. Legal structure determines whether gains remain optional or become immediately taxable. This distinction separates passive holders from intentional ones. Sophisticated participants plan exits before entries. They design pathways that preserve flexibility rather than reacting to price signals alone. This often means prioritizing structures that delay visibility, reduce friction, or align with long-term planning rather than short-term liquidity. It also means understanding that doing nothing is still a decision. Holding without structure leaves outcomes to default rules. Default rules are never designed in your favor. They are designed for efficiency, oversight, and compliance. This stage is uncomfortable because it requires effort before action. It requires confronting complexity rather than avoiding it. But it is also where control is regained. Strategy restores optionality in a system designed to remove it. Those who take this step early move calmly when others rush. Those who skip it discover too late that price alone was never the deciding factor. Everything we have discussed leads to one final conclusion. Silver is no longer just an asset. It is a test of preparation. Markets always reward foresight before they reward conviction. The people who benefit most are rarely the loudest or the fastest. They are the ones who structured their decisions long before pressure arrived. The lesson here is not fear, and it is not urgency. It is clarity. Price moves attract attention, but structure determines outcomes. Supply constraints, industrial demand policy pressure, and taxation all converge at the same point. When that happens, unprepared holders are forced to react, while prepared holders simply execute a plan they already designed. Silver has done its job. It has preserved purchasing power, revealed weakness in paper systems, and exposed how fragile price discovery can be under stress. Now the responsibility shifts to the holder. What matters next is not what silver does, but what you do with the knowledge you now have. Strategic thinking means aligning market reality with legal reality. It means asking better questions earlier. How is value protected, not just grown? How is flexibility preserved, not just liquidity chased? These are the questions that separate long-term stability from short-term relief. No market move lasts forever, but the principles do. Structure before action, planning before pressure, awareness before execution. Those principles apply whether prices rise, stall, or reverse. They are what allow